All right, today we're going to do something really cool. We're deconstructing a pretty sophisticated financial strategy, pulling back the curtain to see how a professional investor can structure a trade that pays them cash right up front, just for making a bet on a company's long-term success. It's a bit of a head-scratcher, right? How in the world can you collect actual money for a stock you don't even own, while at the same time, you're rooting for it to do well? That's the central paradox, the puzzle we are going to solve today by looking at one very specific, very clever trade. So at the very heart of this whole thing is a bet. But it's not just a bet on a company, it's a bet on its volatility. The company in question is Lam Research, a super important player in the semiconductor world. And the trade itself is way more nuanced than just, buying some stock. Okay, so let's get into the nuts and bolts. This is the anatomy of the trade. An investor is selling something called a short put option. Now, what does that actually mean? In simple terms, they're making a promise. They're agreeing to potentially buy 100 shares of Lam Research at a fixed price, $135, at any point before March of 2026. And just for making that promise, they get paid $650 instantly, cash in the account. They're literally getting paid today for their willingness to buy a stock they already like at a cheaper price down the road. Here's my favorite way to think about this. It's just like telling a homeowner, hey, I absolutely love your house and I'm willing to buy it, but only if the price drops to my lowball offer. And by the way, for just letting my offer sit here on the table, I want you to pay me. It sounds kind of crazy, but it's a really powerful idea that turns all that market uncertainty into a steady stream of income. Okay, I know what you're probably thinking. Isn't this super risky? What if the stock just completely tanks? And that's a fair question, but that's where the beauty of this trade structure really comes into play. It's actually designed with multiple layers of protection, creating a pretty substantial financial safety net. First things first, let's get our bearings. At the time this trade was made, Lam Research stock was trading for about $156 a share. Now remember, the price this investor agreed to potentially buy at is way lower than that, $135. And now for the real magic. That's $650 or $6.50 per share that the investor collected right away. That's not just free money. It's also a discount. It effectively knocks their potential purchase price down from $135 all the way to $128.50. That is their true break-even point. And this chart just lays it all out so perfectly. For this trade to start losing even 1 penny, the stock would have to plummet from its current price of $156, crash right through that $135 strike price, and keep falling past $128.50. That's a drop of nearly 18%. That is a massive margin of safety that's just built right into the architecture of the trade from day one. So, of all the companies out there, why Lam Research? Why build this whole elaborate strategy around this one specific company? Well, because Lam isn't just another tech company. It's a quiet giant, a nearly irreplaceable force in the world of making computer chips. Lam Research has what investors dream of finding, a deep, wide moat, a competitive advantage that's almost impossible to overcome. They're absolute masters of engineering at the atomic scale. I mean, just try to imagine drilling a perfectly vertical hole billions of times through a skyscraper that's over 300 stories tall, and each hole is thinner than a single human hair. That's basically what their edge technology does for the most advanced chips. It's a capability that, for all practical purposes, their competitors just can't copy. And there's another hidden layer of support here. The company itself is a huge buyer of its own stock. They've got a $10 billion buyback plan, which means management is pretty much always in the market, scooping up shares. This acts like a giant floor under the stock price, giving it support exactly when it dips, which is precisely the kind of price action someone who sold a put loves to see. The timing of this trade is also just chef's kiss. It's perfect. This isn't just about a great company in a vacuum. It's about a great company that's right at the epicenter of one of the biggest technological shifts in human history, the AI revolution. This slide shows you exactly why Lam is so indispensable to AI. It breaks down how high bandwidth memory, or HBM, which is the lifeblood of AI chips, is actually built. You have to stack these memory chips vertically to make them faster. But then, how do you connect them? You have to etch these incredibly deep, perfectly precise holes all the way through the silicon stack. That's step 2. That is Lam Research's turf. It's their domain. Without them, the AI revolution literally grinds to a halt. So what does this all mean? It means the global arms race for AI dominance creates a demand for Lam's tools that is almost unstoppable. The big tech giants are in a fight for their lives, and they have to get these chips.
This insulates Lam from a lot of the usual economic ups and downs, creating this powerful recession shield around its business, and, by extension, its stock price.
But of course, no trade is risk-free. Every good story has a but. And for Lam Research, the single biggest question mark, the thing that makes investors nervous and, frankly, makes these options so valuable, is its heavy reliance on one particular country. And yep, there it is in black and white. A massive 43% of Lam's revenue comes directly from China. That's a huge number, and it creates some serious geopolitical risk. What happens if U.S. export rules get even tighter and that fire hose of revenue gets turned off? This is the main fear that's baked into the stock price. But, and this is a really, really big but, you have to look closer. You have to understand that not all revenue is created equal. What U.S. regulators are really worried about is stopping China from getting the most advanced bleeding-edge AI technology. The vast majority of what Lam actually sells to China, though, is for older, legacy tech. We're talking about the chips that go into everyday things like cars, solar panels, and consumer gadgets, not stuff that poses a major national security threat. That distinction is absolutely crucial to understanding the real risk versus the perceived risk. So let's put all the pieces back together. You have a world-class company, a massive technological tailwind, a built-in financial safety net, and a clear-eyed view of the biggest risks. When you add all that up, the whole strategy boils down to two very, very favorable potential outcomes. Outcome number one, the stock just behaves. It can go up, it can go sideways, it can even drop a little bit. As long as it closes above $135 in March 2026, the option expires worthless and the investor keeps the entire $650 as pure profit. Done. Outcome number two, the stock actually does take a dive. Well, in that case, the seller gets to buy shares in this world-class, totally indispensable company for an effective price of just $128.50, a massive discount from where it was trading. This quote from the source report just nails it. The strategy transforms the inherent volatility of the semiconductor sector into a stream of income. So instead of being scared of the industry's wild price swings, this trade actually harnesses that volatility. It turns all that market anxiety directly into cold, hard cash. And that leaves us with one final big idea to chew on. Maybe the smartest move in investing isn't trying to find some mythical risk-free bet. Maybe, just maybe, the greatest opportunity comes from finding a risk that you understand so deeply, so completely, that you can confidently turn to the market and say, "Pay me to take it." Thanks for joining us for this explainer.